mortgage loan officer with TD Bank. I service Montgomery County for the most part. TD Bank has stores, we call them stores, not branches, from Maine to Florida. And I am nationally registered on a federal registry as a mortgage loan officer. So I can do properties in any state. So if you're looking, to, for example, to buy property down the shore, I can help you with that. But having said all that, let's get started. Everybody here is ready to buy a home? Right? Okay, you think you are? Yeah. Well, today hopefully will help you feel a lot more comfortable and confident in moving forward and buying a home. It's a process that is made easy. Oops, excuse me. Today's topic, in fact, is making home ownership easy. And that's really a responsibility for everyone here to help yourselves and give you some information this morning to help you get there. If I can get this open. Come on. There we go. Okay. So the topic today is what? Home buying made simple. Did I give someone with my notes on it? The sheet? Already have notes on it? That's okay. All right. You know, interestingly, when I walked into this room, you can walk around it, and this is a math room. This is Mrs. Turner's math class. And if you look around, I like this one over here. It says, why study algebra? Why study math? Luckily, my mother had forced me to do my math homework, and I wound up in the world of finance. And I help people with math in figuring out what you can afford, what you feel comfortable and confident with in affording a home to your liking, wherever it may be. So I take great pleasure in helping people get from point A to point B, learn what you need to do and accomplish and get there, and make it easy for yourself. Reduce the stress level. If you've ever applied for a mortgage before, or if you know people who have, it can be a stressful experience because we are like doctors. You know, we look to, lenders look to examine you very thoroughly and come up with a solution for a problem you may have, or to help you along the way to get to the point where you are ready to buy a home. And having said that, first thing you want to think about here, as we show, is the pros and cons of renting versus owning. Not everybody's made to own a home. 64% of Americans own their home. That's a majority, but there's many millions of people who do not own a home for many reasons. And contemplating that, look at the pros of renting, where you have the ability to move when you want, to relocate on short notice, with little expense. There's no responsibility for maintaining the home. It's up to the landlord or the management company for the most part to take care of the heating systems and structural items and real estate taxes and homeowners insurance. And you get the picture there. The real estate taxes and homeowners insurance are items that you'll be responsible for as a homeowner. But luckily you get tax advantages for paying those items, including interest on your home. Cons of renting, there is no income tax deduction. When you own a home, you get to deduct off your income taxes the cost of the interest on your mortgage. And as a footnote to that, a 30-year mortgage, you'll be paying interest on that loan, mostly interest on that loan, for the first 11 years of a 30-year loan. So there's significant write-offs off your tax statements for owning a home that way. There's no longer a term benefit of investment. In other words, ownership is an asset. Like you have a bank account, you may have a CD, money in mutual funds. Real estate is an asset, part of your wealth portfolio, if you will, that hopefully will appreciate in value over time and certainly have a roof over your head while you're there. Cons of owning include potential tax deduction. Cons of owning a home. Moving requires a sale of the property. You don't know what the market may be. You may have to hold it longer, or you can rent it if you have the wherewithal to keep the property over time and use it as a rental income as to supplement your retirement, for example, or another income source. And in owning a property, you have the freedom to do things with the property that you couldn't most likely do as a renter. Paint any color you want of the walls. add a room, improve the home to your liking and that it meets your needs, and hopefully it will improve in value. Putting a new kitchen in, putting a new bath in. Over time, these are things that you'll likely want to do and contemplate. The cons of owning is moving requires a sale of the home. Again, we've already discussed that. So we move on to understanding your credit and how it can affect your application for a mortgage. Credit is the fundamental of getting into a home if you're getting a mortgage. And 90% of people in the country buy a home and they need a mortgage, which means that you're putting down a percentage, skin in the game, if you will. And today you can put down as little as 3% of the mortgage. And many programs will offer as low as a 620 credit score. So if you're informed about credit scores, 620 is a reasonably low score that most conforming loans, most conventional loans will not allow. You need at least a 660 or a 680 for many, many programs. FHA will allow 585 on a credit score, but many lenders don't go that low because it's just too risky. The loan may fail. So credit is the money that you borrow to pay for everything you do. It's usually referred to as a loan, as a mortgage. You make a promise to pay it back over time, and you pay interest on that loan for the privilege of borrowing those funds. That's how lenders make their money. The interest or extra amount is part of the cost of borrowing the money, and if you use your credit carefully, it can be useful to you. If you're not careful in the way to use your credit, it can cause problems in buying a home. So the fundamental in your life going forward and looking to purchase a home is to be sure and to learn about how to have good credit. That fundamentally means paying your bills on time. And a lot of us have credit problems. Medical issues can cause problems. In fact, it's the largest source of bankruptcies in America. So if you have credit problems, I suggest, or if you don't and you're not sure what your credit score is today, before you go to a lender to run a credit score, because that's a fundamental of your application, I suggest you go online to a source that will offer you 3 scores. Because in the industry, we use 3 scores. There's 3 repositories or credit agencies. There's Equifax, TransUnion, and, right, what's that? Experian, thank you. And lenders will use those 3 scores. And when you get those 3 scores, they will have some variation in the number. It depends on your credit usage, how much credit you have, how much is available to you, how much you use of the total available to you, how you pay it off in time, over time, and certainly the totality of the dollar amount about your credit. Car loans, car leases, all that good stuff shows up on your credit report. A lot of things don't. We'll get to that in a minute. But the fundamental of getting a mortgage and interest rates are based on your credit score. The better your credit score, the better rate you'll get. Question?
Why is there a variance between the 3, where one report gets one number and another?
That's a good question. Each repository has their own algorithm, if you will, of information about customers who have credit. And they analyze it in different ways. Some will analyze to the point of anticipating if you have requested information about credit. Let's say you went to go to buy a car and a car dealership run a credit report on you. Well, that shows up as what's called an inquiry. You've inquired about credit. Well, that's a red flag in some systems to say, ooh, maybe you're getting a new loan, or if you do get that new loan, it's going to show up on your credit report soon, and they want to see that you're going to be paying that on time. So your credit score may be dinged a little bit, a few points down, in anticipation of how will you now handle that new credit. Will you pay it on time? And certainly over a month or 2, paying it on time goes back to the credit agency, and they say, okay, well, you're likely good to go, and your credit score will improve. Credit scores are much like your blood pressure. It goes up and down depending on your behavior a lot. You know, you pay your bills on time. Today you go out and buy dinner and it's you know, it's $150 and you usually don't buy a $150 dinner. Well, that algorithm in one of those credit repositories is going to say, well, maybe you're going to be going out to dinner a lot and using a lot of credit. Things like that. Highest agencies have different levels. They generally run from 300 to 850 or even 900. Folks who have, in most lending institutions, a best credit for best rate is usually above 760 or 780. Okay?
Are those scores obtainable? I mean, the 850s?
Yes.
No, not the 760. I mean, the 850. I mean,
They are.
Yeah.
yeah.
They are. They are. People will not run balances on their credit cards, for example. That's the biggest hit. Average balance on credit cards in America today, are you all sitting down, is about $9,500.
My nephew, I think
So if you're earning $40,000 a year and you've got $9,500 in credit, your credit reports are going to be looking at how you're paying that every month. Every month. You fall short of that, your credit score is going to get hit. Okay? But again, most of the affordable programs out there that we're discussing today, whether it's FHA or a conventional loan, Fannie Mae has a program called Home Ready, for example, that TD Bank uses and other lenders use, that only needs a 620 credit score. And you only need to put down 3%. And the money can come from anybody. Other programs usually mean skin in the game. If you have to have 3.5% or 3% down or any amount down, that money has to come from you, the borrower, the buyer. And so it's important for you to keep records. If you get nothing else out of what we say today, is to start to keep your life organized in preparation for applying for a mortgage and buying a home. Okay? Because we're going to ask for your pay stubs, your W-2s, maybe your tax returns, your bank statements most recently, all that good stuff that I'm sure you've heard about. Question?
When you check your credit, does it hurt your credit?
No.
I've heard that a lot.
It does not.
Hard inquiry.
Yes. In fact, if you go to apply for a mortgage, right, make different applications or inquiries about mortgage rates at different companies and they run a credit report on you, that will not affect your credit score if it's all done in a 30-day period. Okay? Okay? And even if you do have inquiries there, if you haven't established credit for that item, in a month or 2 or 3, your score will build back up anyway. So don't be afraid to inquire. In fact, check your credit. There's an agency that's now by law, I forget the name of it. It's in the brochure.
Requirements, a soft check.
You can do that.
Look at it all the time.
The suggestion I make to you is that if you're checking your own credit, and I implore you to do that before you go apply for a mortgage, because once the lender or the bank runs your credit score, that's the score we're going to use, and we're going to use your middle score of those 3. And if you're co-borrowing with someone else, a spouse or a significant other or a friend or mother, we're going to use the lowest of the middle 3 scores, of the middle score of those 3. Okay?
So should we not, let's say we have different varying credits, we shouldn't apply if one is significantly higher than the other?
Say it again.
My credit's 800 and hers is 600.
Yeah.
So applying together, it's better off me applying by myself. Correct?
If you qualify on your own for the mortgage payment, that's not a bad idea, because otherwise your rate's going to be based on her credit score. You won't get a loan at 600 anyway.
Point, I'm putting extreme
Yes, your point is well taken. Lenders will use the lowest of the middle scores. Okay, so if you're buying with someone else, know that in advance. I mean, the rate is going to be lower. That's really the end result. Question?
My credit card company always gives us a copy of our FICO score.
Right.
So is that different?
The FICO score includes all 3. They're called FICO scores. It's Fair Isaac company. No, if you just get one score, you're not getting the full picture of your credit profile. That's why I say if you go online and find an agency, find a service that will offer you all 3 scores, that's the way to go. That way you know the lender is going to look at these 3 scores and use the middle one, not the lowest, but the middle one shown on the report. Okay? And another thing is you should examine that credit report, not just for score, but for items that are on it that may be derogatory, that may be incorrect, that you can fix, and fix it in advance of making a mortgage application. Yes. Good.
Good morning. Would you happen to know a couple of those agencies? Because how will we know the
Well, Credit Karma is one. I don't really know, I'll be honest with you, but go online, Google credit reports or credit scores, and find one of them. I know there's one or 2, maybe more. They may charge you for it, but try to get to 3 scores.
Annual.
If you get 1 score for free, that'll give you a benchmark pretty much of where you are. And certainly if you're, in the high 6s or 700s plus, and you get 1 score, the others are going to be pretty close to that. But they can vary by 10 or 20 points or so. That's why we use the middle, because we figure, okay, it's an average. They use different algorithms to make your score. So let's be fair to the customer, really. Let's use the one that's in the middle. Not the lowest, not the highest, but the one that's in the middle. Any other questions on that?
No, not on that, if I had another question.
Go
Are
ahead.
people that live on Social Security eligible for a mortgage?
Yes, as long as the income you have supports the repayment of the loan. We use a debt-to-income ratio, and we'll talk about that in a moment. It's called DTI, debt-to-income ratio. So we take your monthly housing expenses proposed for the new home you're looking to buy, principal interest on the loan, real estate taxes, homeowner's insurance, mortgage insurance possibly, if it's a condo fees monthly. And we take that number and then add your monthly debts otherwise, your car loans, your student loans, your credit card debt, monthly revolving, okay? And add that total. That's your monthly debt service, housing plus other monthly debt requirements. And then we take that and divide it into your income. Okay? That ratio is called debt-to-income ratio. If your debt-to-income ratio exceeds, for the most part, more than 41 or 43%, then you've got an issue with getting approved for the loan. Okay? There's ways to fix it. Sometimes, well, I won't go into all those details, but it gives you, again, a benchmark to know where you're going and what you're doing, what you can afford and what you feel comfortable with, and what a lender will allow you. Okay? Any other questions? So we've gone over, and this is incorrect, by the way. How is your score determined? Just briefly, there's some factors here that that create your credit score. About 45% of it really, or 40% of it really, is based on your payment history. Do you pay your debts on time? That's the fundamental. No matter what your debt is, even if you're not paying off a credit card, you got $9,500 a month, and it requires a $100 a month minimum, and you pay that or more, then you're paying it on time. It's revolving, so that's okay. But the total debt may affect your total score. Others, 30% or so, is based on the amount you owe as a ratio to your total available credit. So if you have a credit card that's $20,000 and you've got $18,000 of it outstanding, that's a red flag. You're using the limit of your credit availability. So if you add more to that or you add a mortgage payment to that, it's going to throw you out of the debt-to-income ratio that we need to qualify you for. And then the rest is based on new credit and the number of times that you ask for credit. So that includes inquiries as a brief stay of what are you doing, or if you actually create new debt, that adds to your debt service, monthly debt service. If you go out and buy a car loan today, mostly young people have this issue. They come out of college and they have student debt, the student loans that may be $100 to $400 a month or more. And then they get a job. That's great. Now they have to go to work, and what do they need? A car. So you go out and buy a car or lease a car, and that's another $300, $400 a month. On top of rent you're paying, or if you're living at home in mom and dad's basement, that debt service is going to be a detriment to you getting qualified for a loan. Okay? But because we know that, because the world is aware of that, the mortgage industry has tried to allow for a less credit score, because we understand you got a degree, you got college, you went to school, you're paying the debt and you're paying it on time, that's fine. And you need a car, we understand that. So we raised what used to be a 36% debt to income allowance. That used to be 28, 36. Front end we don't even look at. That's just housing costs. Okay? But your total debt today used to be 36%. Well, there would be so many millions of people who would not qualify for a loan today, and the world comes to understand that realities demand more of a debt allowance to qualify, as long as your score is within reason of qualifying.
So when you're saving up for a down payment for a house, are you better off paying off your debts or saving up for a larger down payment to get yourself, what will give you the better rate?
It depends.
On?
It depends. If you have to pay off a debt, I had a gentleman just the other day who has a tax lien, federal tax lien of $35,000, and he's paying $500 a month. Now, if he were to pay off that $35,000 debt, that may, for most people, take away from the money you need to buy a house for down payment and closing costs. Okay? But if that $500 a month is not killing you for debt to income ratio to qualify, then I'd say don't pay it off. Okay? Most people don't have $35,000. Question.
Can you tell us what actually shows up on your credit report?
What does? We'll get to that in a minute. Good question. So here's what contains on your credit report. Let me go back here. Past and future, what you've done in the past, what you anticipate to do in the future based on your inquiries on your credit report and so on, will show your willingness to pay and your ability to pay, capacity, not just your willingness. Willingness is a soft word. Well, you're willing to pay, but do you actually pay on time is the big question. So it contains the following. You get summaries about real estate. If you own real estate, primary and second mortgages on your home. You may have a first mortgage, you may have a home equity line of credit. If you currently own a home and you're looking to buy another or refinance that home, that's an issue. Revolving accounts we just talked about, mostly credit cards, car loans, things like that, installment loans included. Other accounts that may be on your credit report that may be tax lien that you have to pay off, things like that. Collection accounts, those are seriously past due, can be a detriment to you qualifying for a loan. So if you have, for example, a charge-off where you had a credit card with Macy's and you didn't pay the bill, and they bugged you for months and months to pay it off, and then they finally decide, okay, you're not paying it. They may send it to a collection agency. You don't pay them either. They write it off. That's a charge-off. That's a real bad red flag on your credit report. Okay, so if you have issues with a credit card company or agency, go ahead and call them and talk to them. Arrange for a pay schedule if you can, or call a credit agency like Credit Repair to discuss with them what they may be able to do to help you. These are all things you need to do in advance before you make a mortgage application. Because if you can fix your problem, you may need to wait to buy a home, okay, to build up your credit score. But if you can fix whatever issue you have in advance, then once that's fixed and your credit score starts to build back up, now you've got a much better chance of qualifying for a mortgage. Okay? So, the credit report includes the following things: the total number of accounts that you have, the amount you owe on the accounts, monthly payments you must make on each account, number of accounts for which payments are past due or delinquent, that have derogatory statements on them as well that negatively impact your credit score. So you see the importance of your credit score. Got it? So you can request the credit report, and you have this all in your papers there, from the agencies themselves, or go to annualcreditreport.com. You can get a free report. It's only going to give you one score. So that's why I say go Google online and search for an agency that will give you the 3 scores you need before you make an application. Okay? So paying your bills on time is the fundamental. So let's talk about how much money you're able to spend up front for a home purchase. Upfront costs. That includes down payment and closing costs involved in the loan. And you have to decide, in organizing, what I said earlier, a very important thing is to organize your records from today going forward if you're interested in buying a home. If you go to make a pre-approval application, for example, that will give you a letter that will actually say that you have been pre-approved, conditionally pre-approved by the lender, having run your credit report, having seen the score and it's acceptable to them, and based on the information you've told us about your income, employment, your assets, liabilities, and so on, we will approve that loan based on the verification of those documents. So when you buy a home and you now have an agreement of sale in your hand, and you've had a pre-approval, all you need to do is present the agreement of sale to the lender and say, oh, now we're a formal application, and then they will at that point request your most recent pay stubs, your current bank statements for the last couple of months, your W-2s for the last 2 years. We want to see, lenders want to see that you're employed. We go back 2 years for most everything. Okay? Life in the United States is monthly. You pay everything in life monthly. Well, we look at things monthly also in creating the calculation for your debt-to-income service. So it's important to just organize, keep the documents going forward, save all your pay stubs, save your bank statements, because we're going to need, lenders need at least the last 2 most recent bank statements to see that you have the funds available to make the transaction of purchasing a home. Okay? And if not, where's the money going to be coming from? You can get a gift. You can get a gift from parents. Now, that's a whole other subject. You can get a gift from anybody, really. Somebody can give you a tax-free gift for $14,000. Anybody. Usually relative, if they love you. But that money can come from a gift. If you don't have enough and you can get a gift, or today you'll learn also later on about qualifying for certain programs that will, grant funds that will give you money to help with a down payment closing cost. Second mortgages that are grant funds also not to be repaid. Question?
If you get a gift, do you have to provide documentation?
Absolutely. The middle name of mortgage is document. Document, document, document. And it sounds harsh, but I want you to, if nothing else today, again, document. Keep organized, keep your pay stubs, keep your W-2s, keep your bank statements. If you have mutual fund statements or retirement fund statements, 401ks, IRAs, keep all the documents, because when you make that application for a mortgage, that's what they're going to base your approval on, is seeing those documents to verify the information that you have the income, you have employment, you've been working for 24 months, hopefully in the same line of work, or have been in school and now you're starting a job. Show us your transcript and your diploma, perhaps. So we know that your likelihood to support paying the loan for which the home is the security. Okay, the home is the collateral, and your history of payment and income is the support to repay that loan on a monthly basis over 15 or 30 years. Okay? So the true cost of obtaining mortgages, we're talking about costs. Closing costs. Closing costs are needed to pay on most loans and can range from 1% to 5%. That's a wide variance depending on where the home is that you're buying, because closing costs include upfront funds to pay the real estate taxes on that home. And taxes vary from community to community. So, Cheltenham Township, for example, in the area has higher taxes than most other surrounding communities, except Philadelphia. So, if you're buying a home, you want to know up front. So if you're shopping for a home, go online, talk to the realtor. Always use a realtor. Got that? Everybody raise your hand. You hear me? Always use a realtor. Going into a transaction of real estate requires knowledge. It requires experience. It requires knowing the contract itself. And it's a boilerplated contract that the Board of Realtors use in the state of Pennsylvania. And by law, all real estate transactions must be in writing. So anything you want out of that transaction going into it and making your offer to purchase has to be in writing. You won't figure it out on your own. And you won't include things that you wouldn't think of that a realtor will. Find a realtor that you trust, somebody you know who knows a realtor, your neighbor may be a realtor, make phone calls to a realtor, and use a realtor who will advocate for you as a buyer's representative. Most realtors will be representing the seller of that home you're buying. And they're responsible, fiduciary responsibility is to the seller of that home, not to you as a buyer. Follow? This is important. So if you can find a real estate agent who will actually sign an agreement with you, and they love to do it because they want your loyalty. Okay? If you sign an agreement with a realtor and saying, I'm going to use you exclusively to help me find a home, and the realtor says, I'm going to help you find a home and keep your personal information personal and confidential. So they represent you and your information is confidential to the other real estate agent involved and the seller involved in the property. So that's very important. Okay? Protect yourself. Closing costs further, all right, because of the taxes, they could vary from 1% to 5%, usually around 2% of the loan amount, or let's, in this example, $2,000. $200,000 loan amount, approximate cost would be about $4,500. That's on top of the down payment. You follow? So there's a lot of costs involved, and everybody has their hand in the till on a real estate transaction, appraisers and real estate agents. By the way, when you have that negotiation and make an agreement with a real estate agent to be your buyer's representative, that agreement should state that the commissions earned by the real estate agent are not paid by you, but by the seller of the home, which is normal and usual. Okay? So they're working for you, but the commission is paid by the seller. Escrows. These are funds that are collected and put aside by the mortgage company at closing to allow the lender to make tax and homeowners insurance payments throughout the life of the loan. If you put down less than 20% of a mortgage, 20% down for your mortgage, you will be required to have the lender hold escrows. There's a reason for that. Real estate taxes are really the first lien against the home when you buy it, even before the mortgage company. So if you have problems paying your taxes, mortgage company is second in line to get repaid. If the tax man can come and take your home, they can foreclose on you. If you're in a condominium and you don't pay your condo fees, they can put a lien on your home and foreclose on you if you don't pay it. Okay? So not only is the mortgage important to pay, but the lender wants to see that because there's a lot of risk involved in you not paying taxes with less than 20% down against the purchase price, then we're going to escrow funds. We're going to collect enough funds at settlement to pay for the next levy period, that it's called, when the taxes are next due. Okay? And the owner of the home, if he's paid taxes to that point, will get refunded for it at the settlement table when you close. Okay? So you're going to need to pay a certain portion of real estate taxes coming due, school tax, county, township tax, so on, at settlement. So that's part of the escrow amount that we collect to pay and have enough in your account to, going forward, to pay your taxes on your behalf, that the lender wants to be sure they're getting paid, so we collect it and hold it in escrow. It's another way of budgeting, really, from a positive perspective as a homeowner, because when taxes come due and they're $4,000, well, I don't have $4,000. But if you've paid it and budgeted along the way, then there's not an issue. You don't have to worry about it. You can sleep at night. You have a question? No? Okay.
Closing costs are for tax and the escrows for tax?
Closing costs are taxes and escrows and other items. There are items that the lender requires, and there are items that the tax agencies require. We also will hold escrows for your homeowner's insurance. You can't get a mortgage without homeowner's insurance. That's otherwise called hazard insurance. It'll prevent it, if there's a fire, God forbid, or the house, blows over in a windstorm, whatever. That is the security for your loan. So we want to make sure that the house is in good shape and you have homeowners insurance to recover the damages made. So it's a risk element for the lender that you have homeowners insurance. There's also title insurance. Title insurance is something that the lender requires. It's lender's title insurance, which means that they get a title company to search the records, the hall of records, and make sure there's no liens against that property. Once you buy it, you're getting it free and clear of any debt or any claims against that property.
Who does that?
Say again?
Who does that? Who checks that?
The title company. In Pennsylvania, you as the buyer have the right to select your own title company. But it's lender's title insurance that you as a buyer get the pleasure to pay. But you can choose who does it. My suggestion is use the recommendation perhaps of your real estate agent, because they have long-standing relationships with various title companies. They may have an affiliate title company. Basically in Pennsylvania, the cost for title insurance is regulated by the State Insurance Commission. So cost for title insurance will be pretty close from company to company.
Real quick.
Sure.
Some offers of 10% down, no PMI. Is that legitimate, or are they just building in the PMI payment into the interest somewhere?
You're a smart guy. That's pretty much what happens. Okay. However, the benefit there, okay, PMI is if you put less than 20% down on a house, you're going to pay private mortgage insurance, which covers the lender in the hopefully a very unlikely event that you foreclose or default on the mortgage, because they've got the higher risk. You're putting down, 5-10% perhaps, and so the lender's covering what, 95 or 90% or even 97% if you put 3% down of that loan. So if you default on the loan, the mortgage company or the bank says, well, we're at loss here. How do we recover this? Okay? So when you put 10% down, the mortgage insurance helps defray the risk of your default to the mortgage company, to the lender, to the bank. Okay?
So the interest is building into the other 20%? They're paying.
In most programs that allow for lender-paid mortgage insurance, there's never no mortgage insurance.
Right.
If it's less than 20% down. Depends on who's paying it. FHA, for example, charges an upfront premium to the borrower in addition to a monthly payment. Many of the conventional loans outside FHA, the Federal Housing Administration, that's a government-insured loan, or a conventional conforming loan from a bank or a mortgage banking company will, I lost my train of thought here.
You're
Help me out.
talking about where who pays the PMI?
Right,
Whether it's
they
lender
may
or
offer a
borrower.
program that is lender-paid PMI. In other words, the lender will pay the upfront premium, and there may or may not be a monthly premium, usually not if it's lender-paid PMI. So, however, the rate may be a little bit higher. The benefit of that, I was getting to, thank you, is that it now becomes part of your mortgage payment, principal and interest. You can't write off from your taxes private mortgage insurance.
Gotcha.
Okay, so and it depends on the loan size. It may be $100 or more a month for mortgage insurance. Okay, but if it's packed into the loan amount, then it becomes a tax write-off for you. You know, it's just calculated as interest. It's hidden. We need to wrap up. Okay, we got good questions. That's what's happening.
There's lots more workshops coming up. That are answering
Okay, give me just a few more moments. So let's talk real briefly. Let's give just a couple of minutes here because this is very important about what you pay in your mortgage. Okay, the anatomy of a mortgage. Your principal. The principal is the amount of the money you're borrowing. The interest is the fee or the interest that's the profit center for the monthly payment over the term of the loan, representing the cost to the lender to provide the loan. So the interest is compounded over time. It's amortized over 30 years. And like I said, it's mostly interest for about the first 11 years of the loan. Your real estate taxes is a requirement. You must pay real estate taxes either on your own if you're putting 20% or more down or through escrows. And homeowners insurance, we discussed briefly for your single-family home. And if it's a condominium, condominium, by the way, is not a type of dwelling. It is a
the other groups waiting.
all right, it is the type of ownership in the property. So there's condo fees potentially, and the private mortgage insurance. Luckily, you have this document to take with you, and if you have,
You're around at your booth to answer anyone's questions.
yes, thank you very much. All right,
Thank you.
thank you for your question.